What if the next global financial crisis isn't coming from banks or the stock market, but from a system most people have never even heard of? Just months ago, a company called Renovo Home Partners quietly went bankrupt. On the surface, it seemed minor, but behind it were billions in loans tied to giants like BlackRock, suddenly thrown into doubt. This didn't happen in public markets. It happened inside private credit, a $2 trillion shadow system built after 2008. For years, it looked stable. Now cracks are forming, and if this hidden market starts to break, it could ripple far beyond anything investors are prepared for. Section 1. The multi-trillion-dollar shadow market. Okay, so to understand the danger we're in, we first have to understand what private credit actually is. And to do that, we need to go back to the aftermath of the 2008 financial crisis. After the global economy was brought to its knees by risky lending, governments passed new laws like the Dodd-Frank Act in the United States. This forced traditional banks, the J.P. Morgans, the Bank of Americas, to become much more cautious. They had to hold more capital and were restricted from making certain types of risky loans. It was like a town that had just survived a flood building a massive dam to make sure it never happened again. But the demand for that risky lending didn't just disappear. Thousands of medium-sized businesses still needed capital to grow, and private equity firms needed massive loans to fund their leveraged buyouts. So if the regulated banks were saying no, where did they turn? A whole new ecosystem of lenders slipped in between the cracks. These are the private credit funds, run by the biggest asset managers in the world: Blackstone, Apollo, KKR, and yes, BlackRock. This is the shadow banking system. They operate outside the strict regulations that govern traditional banks. They don't take deposits from everyday people, so they don't have the same safety nets or oversight. An easy way to think of this is that your local bank has to follow a very rigid, standardized menu of options. These private lenders are more like a private chef, willing to cook up almost any kind of loan for the right price. And because they took on the risk that banks no longer would, they could charge a premium, offering loans at higher, often floating interest rates. For a decade, when interest rates were near zero, this model was a rocket ship. Investors, desperate for any kind of return, poured hundreds of billions into these funds. The market exploded. From a niche corner of finance, private credit has swelled into a global market worth around $2 trillion, with some projections seeing it hit nearly $4 trillion by 2030. In essence, the risk wasn't eliminated from the financial system after 2008. It was just moved. It shifted from the highly regulated, somewhat transparent banking sector into the opaque, lightly regulated world of private funds. For years, this was seen as a win-win. Companies got funding, and investors got high yields. As long as the economy was growing and interest rates were low, the party raged on. But then, the music stopped. Section 2, the agitation. The cracks appear. Every financial bubble is a story of debt, and every crash begins when that debt becomes too expensive. The private credit bubble is no different. The era of free money ended abruptly as central banks hiked interest rates to combat inflation. For the thousands of companies with floating rate loans from these funds, this was a catastrophe. A loan that was manageable at 3% becomes a backbreaking burden at 8% or 9%. Their debt payments spiraled and their cash flow evaporated. So then, what went wrong? Well, the bills are coming due. The first crack is the spike in defaults. For years, the official default rate in private credit was almost comically low, often below 2%. But that number was an illusion. It masked a much uglier reality, thanks to a devious trick called a PIK toggle. PIK stands for payment in kind. When a company can't afford its cash interest payments, the lender might allow it to pay with more debt. Imagine you can't afford your credit card bill, so the bank says, "Don't worry, just add this month's payment to your total balance." It keeps the loan from being officially called a default, but the company sinks deeper into a debt spiral. The use of these PIK toggles has been rising dramatically. When you factor in these hidden defaults, the true distress rate in the private credit market is significantly higher than the headline numbers suggest. While that might not sound huge, it represents a tectonic shift for a market used to near zero defaults. Some analysts have even floated worst-case scenarios where defaults could surge dramatically, particularly if new technologies disrupt the business models of these heavily indebted companies. The data underneath is even more terrifying. A significant portion of all companies financed by private credit are now burning more cash than they generate. They are, for all intents and purposes, zombie companies, kept alive only by their lenders' willingness to extend more debt. This brings us to the smoking gun, the specific failures that prove this is not a theoretical problem. We started with Renovo Home Partners, but Renovo is just one of many. JP Morgan's CEO, Jamie Dimon, has famously warned that in credit markets, when you see one cockroach, there are probably more. The cockroaches are now scurrying out into the open, and this reveals the greatest systemic risk, the utter lack of transparency. These loans don't trade on a public exchange. Their values are estimated internally by the funds themselves, a practice known as mark-to-model accounting. As the Renovo case proved, a lender can claim a loan is stable one day, even when the company is on the brink, and then have its value collapse the next. It creates an illusion of stability that can shatter in an instant. This is concerningly familiar to the dynamic that played out in 2008 with mortgage-backed securities, financial trash hidden in a polished can. The reality is that we have no real idea of the true value of the assets in this $2 trillion market until it's too late. The Financial Stability Board, a global watchdog, admitted in late 2025 that there are severe limitations in the data available. Regulators are flying blind. CTA. If you're finding this analysis valuable and you want to understand the hidden forces shaping the global economy, consider subscribing. We release deep dives like this every week to help you connect the dots and see what's really going on behind the headlines. Section 3. The implication, what a crash looks like. So, a few over-leveraged companies go bankrupt. A few giant asset managers lose some money. Why should that crash the global economy? The answer lies in two key concepts: liquidity, mismatch, and contagion. Let's start with the liquidity mismatch. This is perhaps the most critical structural flaw. For years, private credit was for sophisticated institutional investors like pension funds, who would lock up their money for 5 to 7 years. But in the hunt for more capital, asset managers began packaging these loans into new funds for everyday retail investors, often promising they could get their money out quarterly or semi-annually. Do you see the problem? The funds are promising short-term liquidity to investors while holding long-term, illiquid assets. A private loan can't be sold in a day like a share of Apple stock. This is the classic asset-liability mismatch, and it works fine only as long as more money is coming in than going out. But now, as fears mount, the outflows have begun. We're seeing these funds gate redemptions, a polite term for telling investors, sorry, you can't have your money back. Recently, a fund managed by Blue Owl had to limit withdrawals. Even BlackRock quietly announced it would be limiting withdrawals on one of its major credit funds after a wave of requests. When the world's largest asset manager starts blocking investors from getting their money back, that's not just noise. That's an alarm bell. This rhymes with the events of August 2007, when the French bank BNP Paribas froze redemptions from funds exposed to subprime mortgages, an event now seen as the canary in the coal mine for the 2008 crisis. This is where contagion begins. These private credit funds are deeply interconnected with the traditional banking system. Banks provide leverage to the private credit funds themselves, lending them money to amplify returns. According to a release from the Fed, lending commitments from banks to private credit saw a 12 times increase in the decade leading up to the end of 2024. Further analysis from ratings agencies suggests that today, bank exposure could be significantly higher. So not great. The Bank of England's governor, Andrew Bailey, has highlighted the urgent need to understand this interconnectedness, warning these opaque structures could create systemic vulnerabilities. So picture this scenario. A few more high-profile bankruptcies cause a panic. Retail investors rush to pull their money out. The funds, unable to sell their illiquid loans, are forced to draw on their credit lines from traditional banks all at once, putting immense strain on the banking system. Sensing the risk, banks rein in their lending to the sector. This chokes off credit, causing even more private companies to fail. The funds are then forced to fire sell their assets, causing valuations across the entire market to collapse. Who gets hurt? Everyone. Pension funds and insurance companies would suffer massive losses, jeopardizing the retirement savings of millions. The stock market would plummet. The thousands of companies that rely on this funding would face a credit crunch, leading to widespread layoffs and economic contraction. The contagion would spread from the shadows into the real economy. The IMF's managing director, Kristalina Georgieva, said the risk in this sector keeps me awake every so often at night. Conclusion: the unanswered question. So is private credit about to crash the global economy? Here's what we know. We have a multi-trillion-dollar market that grew exponentially in the dark, fueled by cheap money. We know it's riddled with opaque, potentially misvalued assets, and its true default rate is much higher than official numbers suggest. We know its core business model has a fundamental liquidity mismatch, and the first signs of a bank run are appearing as major funds block withdrawals. And we know it is deeply intertwined with the traditional banking system. Again, these concerns are shared amongst basically all of the big names in finance at the moment, from the IMF to the Bank for International Settlements. The counter-argument is that this is just a normalization that will shake out weak players. They argue that unlike 2008, the risk is held by sophisticated funds, not on the balance sheets of deposit-taking banks. But this misses the point. The risk didn't disappear, it just changed its address. And the connections back to the core banking system are far deeper than many want to admit. Now, I just want to say that for the record, I really genuinely hope I am wrong about this. But we are in a new and dangerous phase of the credit cycle. For the first time at this scale, this massive, unregulated part of our financial system is being properly tested. The system was built for a world of 0% interest rates and endless growth. That world is gone. Now we are left with a sobering reality, a $2 trillion time bomb of debt, hidden in the shadows of the global economy, and we don't know when the timer is set to go off.